Well, good morning, everyone. We're going to start now because we want to get everything into the program. We have some time at the end. We will be doing some networking. Thank you for joining us for another LIAFPN meeting. We're very excited to announce our next get-together will be live. We're having just a cocktail after-hours party, July 15th. Mark your calendars. We're scheduled to do it at the Hilton on 110. Very easy for everybody to get to, and we've met there before and hope to see some people live again. It's tough. It's been a tough year or so. Future meetings starting in the fall, we're going to be doing a mixed bag of both Zoom meetings and live meetings. And our rationale is that many people have joined the LIAFPN outside of our immediate area because of Zoom, and we don't want to alienate anybody. And of course, getting to see and talk to everybody face to face is always a preferable meeting method. Today, we're very honored and pleased to have Kim speak. Kimberly is new to LIAFPN, and she is an expert on devising settlement annuities for plaintiffs and judges in the court space for claims. So with that, Kim, take it away. And
thank you, Neil. Thank you for the introduction. And good morning, everyone. It's nice to be here and be part of the group. Again, my name is Kim Taylor. My company is Settlement Funding Associates, and we are located in Fort Lee, New Jersey, and we are nationwide. And we've been providing structured settlement services nationally for over 38 years. Our client base is typically plaintiff attorneys, trial attorneys, but we also provide services to liability carriers, self-insureds, TPAs. I've been with Settlement Funding now for 30 years, and I'm the owner and the president. And when I was first asked to join Settlement Funding to do or sell structured settlement annuities, I said, well, tell me what a structure is and I'll tell you if I'm interested. It's a relatively new product, around 45 years old, almost 50 years old. So it's relatively new in the industry. So what exactly is a structured settlement? A structured settlement in a nutshell is a fixed annuity with some bells and whistles. The criteria for structured settlement has to be a personal injury or the loss of a loved one. And they're used in cases where there's a claim and has to have, like I said, a physical injury. So they're used in cases for personal injury, medical malpractice, workers' compensation claim settlements. And they're offered by life insurance companies. Sure, we've all heard of New York Life, MetLife, Berkshire Hathaway, and a whole host of others. So it is a fixed annuity, but it must fall under the criteria of some IRS codes as well, namely sections 104A2 and 130. When there's a personal injury settlement, the plaintiff receives their settlement tax exempt. However, once they start investing those funds, they're going to pay interest or taxes, on the interest that's earned. With the structured settlement, as you know, a fixed annuity does earn interest, but that interest is also 100% tax-free. And because the product is so unique, where there has to be a physical personal injury or a death, it's not available in the marketplace, and it also has to be made part of a claim settlement. So a person, in order to receive a structure, has to have a claim, settle their case, and as part of that settlement, the structured settlement has to be incorporated in that. So they can't take their money up front and then later on themselves decide they want a structure. The structure has to be purchased by the defendant, liability carrier, self-insured, whoever's paying that claim. And in death claims, when there's a loss of a loved one, the structured settlement would be for their surviving spouse or children or whoever the next family member might be who's entitled to the money under the decedent's estate. With structured settlements, it has to be a settlement. it cannot be a verdict unless you're in New York, where there's the 50A and B rule in New York that says a structured settlement has to be part of the verdict in those cases. But for most other states around the country, it must be a claim settlement. And the parties have to agree on a number, agree that there's going to be a structured settlement. It must be included in the release that the parties are going to enter into. And the defendant or liability company paying the claim must also agree to fund the structured settlement on behalf of the plaintiff. The plaintiff or the plaintiff attorney cannot take receipt of the funds that are intended for the structured settlement. Otherwise, we create tax implications, and then we can no longer backtrack and fund a structured settlement for the plaintiff. So why should a plaintiff opt for a structured settlement? Well, there's many, many, many reasons. One, it might help settle the claim faster. Two, the plaintiff, when hearing these large numbers that they've never encountered before in their life, they don't understand what those dollars in a lump sum equate to. So when you can break down a settlement that they might be receiving in the terms of monthly income, they can comprehend that and can compare that to their paycheck or Social Security check. They know month to month or week to week what their earnings are. And a lot of times in settling cases, it's much easier for the plaintiff to understand that they're getting $1,000 a month for X number of years or for life, rather than you're getting a $500,000 net settlement to you. And what does that mean? One of the biggest factors in structured settlements are the guaranteed payments. As you know, with fixed annuities, once you fund them, those benefits are guaranteed. So the plaintiff is more likely to want, after a catastrophic accident where they might not be able to work anymore, they want the guaranteed returns. They want the safety of, fixed income, the safety of a life insurance company paying them. And they want the security, knowing that, okay, I'm no longer working. I can't work because of my injuries. And I know with the structured settlement, I'm going to be receiving this money for however long or short a period that I want. And a lot of time that is peace of mind. We hear from a lot of our clients and a lot of our competition that, well, interest rates are so low, why would you want to lock yourself into a structured settlement? Again, for many reasons. Most of the plaintiffs that we work with and who have been involved in a case and are injured, their case has been going on for 2 and 3 years. They're not working. They have no income. If they're married, perhaps their spouse is, picking up the tab and they only have one income coming in. They might have children. They might be collecting Social Security. Sometimes they're not. So they've waited 2 and 3 years until this settlement is achieved. And now they really need the income. So if they're not working and they don't have any money coming in, they're not comfortable investing their money, all of it anyway, into the stock market. We're not saying that that's not something that they should or shouldn't do. It's just most of them have lived paycheck to paycheck. I think the average plaintiffs that we work with are wage earners under, $75,000. We do have some exceptions, but for the most part, they live, paycheck to paycheck. They're not comfortable with investments, and they have no knowledge of how to invest in the market, and it scares them. Because they're not working and the settlement is most likely all the money that they're ever going to receive, then they don't want to risk losing any of it. So for a comfort level, they like putting some of their net proceeds into a structured settlement. Again, it gives them that safety, security, and peace of mind. The money is paid to them immediately, so they don't have to wait for it to grow or wait for investments to pan out, or to make, to have money in a CD where you have to tie it up and you can't, touch it. So it gives them immediate fixed predictable, guaranteed, tax-free returns that they can rely on. And again, when the plaintiff receives a net amount, we don't place all of it into a structured settlement. Again, we don't want to tie up their money. They've been injured in an accident. They have ongoing needs. They might need a new home. They might need modifications to a home. So there is a real need in most cases for part of it in a lump sum payment, part of it for investing where they can kind of put it away into a conservative market and let the money grow, and then placing some into a structured settlement. When I meet with plaintiffs, I try to do an analysis of what their needs are. In doing that, this avoids them later on regretting a decision to put the money in a structure, because once the money's in there, we can't change it. They can go to a company like J.G. Wentworth, which I'm sure you've heard the commercials. It's your money and you want it, I want it now. And we want to avoid plaintiffs having to do that later on. So it's very important to design a payment stream with them directly that's going to meet their everyday living expenses. Usually I suggest the structured settlement for everyday living expenses, food, utility, gas money, mortgage, rent payments. Sometimes they have to pay for their own health care going forward. So, money monthly for healthcare premiums. They can also set up and design college education funds for their children. And the nice part about doing college planning with someone's net proceeds is that the money can be paid when their children are 18, 19, 20, and 21. You can give them annual payments, but the premiums go to the injured party, the parent, not the child. And this way they have full control over it. It's 100% tax-free. It's guaranteed. They know exactly in those 4 years what's going to be paid. And it's unlike a 529 plan where it has to be used for educational purposes. We call it an education plan. But if the child, when they turn 18 and they get a free scholarship, or they have money for college, or they're not going to college, the parent who's receiving the structured settlement can do whatever he wants with the money. It does not have to be used for education, but it's nice to know that they have that option if that's important to them in their settlement. They need money for a rainy day as well. So like I said, there's usually what we call 3 pots. There's a lump sum, there's a little bit of money for investing to put away and let it grow in the market. And then there's money that should be allocated to a structured settlement. With cases involving minor children, however, it's a little different. Most of you know that the court system will not allow a minor to receive money. So if a child is injured in an accident, has an injury, their settlement is going to be deferred until they're age 18. In some cases where there's catastrophic injuries, where they have ongoing medical, the courts will allow monies to be paid to a guardian ad litem or a parent that's been approved and appointed by the court. And the money has to be used on behalf of the child. They can't use it for their own needs, but it has to be used on behalf of the child. When we structure cases for minors, it's advantageous as opposed to putting the money in the court. So typically for children, the money would go, their net settlement goes into the surrogate's court. When they turn age 18, they get that lump sum paid to them directly at 18 for the principal and the interest. Whatever interest is earned from the surrogate's court, they have to pay tax on that. And since it's paid in a lump sum, a lot of parents are very leery of giving an 18-year-old child hundreds of thousands of dollars. Sometimes it could be millions of dollars. And they want to avoid that. So with the structured settlement, we can start payments for children at age 18 when they reach majority, but we spread it out over time. So we can also do college planning for them. We can do lump sums at ages 21 or 25 or 30 to meet life events. They want to go to college. They want to continue their education. They want to start a business. They want to buy a house. At specific ages, they know that that money is going to be there to allow them to do that. And again, it's 100% tax-free, principal and all the interest that's earned. And the parents typically prefer the structure over a single lump sum payment. But again, the court has to approve that as well. So we also have to be careful when we're structuring for children that it's going to be something that the court is going to approve. If we have a relatively small amount of money, let's say of $100,000, and we give them a small payment at 18, but then defer the rest to age 50, the court's not going to approve that. They want the child to be able to use that money for whatever they want when they reach age 18. So we also have to be careful of the design when we're doing structures for incompetent people or minors in cases where the court needs to not only approve the settlement, but also the structure format that we're putting in place for them. And sometimes the courts will come back to us and say, okay, well, you know, I don't like this, let's change it. And we have to abide with what the court wants. I've had cases where the parents have said, you know, we have college education already taken care of for our child. We don't want 4 payments at 18, 19, and 20, you know, 18, 19, 20, and 21, but rather we want to defer payments to age 25. Sometimes the court doesn't allow that, even though that's the parent's desire, college is taken care of. The courts always like to see something at age 18. So as I mentioned before, there are many advantages to a structured settlement. It could help settle a claim faster because it translates lump sum dollars into monthly income for the plaintiff. The principal and interest earned on the structure is tax-free, federal, state, income tax, dividends, capital gains, free from everything. There's no 1099, no taxes. We can design a stream of payments to meet their specific needs. When you invest money in the market, you don't know month to month, year to year, what you're going to be able to draw out of it. It depends on the market. With the structure, they know exactly what that payment is. We can even design the payment depending on the amount of money where it covers their mortgage payment. They don't have to worry about that going forward. The other thing with the structured settlement, there's all types of terms and formats that they can design. It can be for 10 years, 15 years, 20 years, 30 years. It could also be for a lifetime so that the money never runs out. We do a lifetime annuity with a guaranteed certain period, you know, depending on their age, it'd be a certain guaranteed period of, you know, 20 years, 25 years, 30 years. And it is one of the only products that offers lifetime guaranteed income. And again, when attorneys or clients or someone compares the structured settlement rates that they're low, we always tell them this is not an investment. This is an insurance product. This is peace of mind. This is going to give you payments for the rest of your life. So although the interest rate might be important, in situations with personal injury victims, it's really about safety and security and guaranteed returns. They have no, like I said, and I can't stress it enough, that most of the families that we work with, the injured party can never work again. They're catastrophic injuries, and these settlements are, you know, they're very large settlements. So although the interest rate, yes, is important, it's not as important as the advantages and the options that the structure brings to the table. You know, you have growth and guaranteed returns. Also, the plaintiff doesn't own the structured settlement. So it's not like a life insurance policy or a regular SPIA where they would own the annuity. The annuity is owned by the insurance company offering it. It's owned by MetLife. It's owned by Berkshire Hathaway. And because it is not an asset of the plaintiff, it's protected from creditors' judgments and is normally not subject to marital distribution. And again, because the life company owns it, it's not an asset, and it falls within the IRS codes. That's how it's tax exempt to the plaintiff and has those other protections. The structured settlement, as I mentioned, is a fixed annuity. However, there's no 10% penalty for payments received before age 59 and a half if it's on a term certain basis. That doesn't exist. So that's why we can start payments for children at 18 or people who've lost their income and they can no longer work. They can receive payments at any age with no penalty applied to it. The product is offered through highly rated life companies. The courts want to see that. If they're going to approve structured settlements for incapacitated people, minors, they want to make sure these companies have been around and are going to stay around for the long haul. So the majority of the companies that we utilize have an A+ or better rating by AM Best. That's not to say that AIG doesn't offer structured settlements with an A rating, and the courts would approve it. But for the most part, our clients really feel that the A+ or greater, or an A++ is in the realm of where they want to be in the market. So those companies would include, like I said, MetLife, New York Life, Pacific Life, Prudential, Berkshire Hathaway, United of Omaha, just to name a few. The risk with an annuity is extremely low. They typically don't fail, and therefore it's a product that is backed by a lot of other entities. We do a lot of work with the American Disability Association. Those clients either were born with an issue or developed one later on from an accident. But again, because you're dealing with incapacitated individuals, a lot of them have a guardian. We don't want to incur risk. We want to keep them financially secure. And so a lot of those organizations really look to structured settlements when making recommendations to their clients in the settlement to place some of it into the structured settlement annuity. As I mentioned, the structured settlement is a fixed annuity. However, you can add a cost of living adjustment rider to that, and that can be anywhere from 1% up to 3%, or 3.5% in some cases. So each year the payment automatically goes up to adjust for the cost of living by whatever denomination you put in there. So if you're using a 2%, it's a 2% increase annually for the life of the annuity or the lifetime of the plaintiff. So it doesn't go up for more than that. You have to designate that and set that at the time you're funding it. But we can include what we call the cost of living adjustment riders. Structured settlements, like I mentioned, once they are funded and part of a settlement, we can't break them. The only way to break them would be to, unfortunately, go to a company like J.G. Wentworth to sell all or a portion of the structure. And we want to avoid that at all costs because they pay pennies on the dollar for the structured settlement. And that's why we try to leave an available amount in cash, again, so that that doesn't happen. What the annuity also has as an option is a commutation rider. And the commutation rider is for when the plaintiff passes away. So when a plaintiff passes away with a structured settlement, the beneficiary would typically receive the payments as they were designed for the injured party. So that could be, payments for the next 20 years on a monthly basis. With the commutation rider, instead of the beneficiaries receiving those payments in the original stream, the annuity upon death would dissolve at the present value at the time of death using the interest rates at the time. And then a lump sum payment would be paid to either the estate or beneficiaries. And therefore, if there's any estate tax due, that money would be available in a lump sum to pay for that, to pay for the taxes. The other reason we use a commutation rider is when we are doing structured settlements for minor children. And if the child dies, because again, a lot of them do have catastrophic injuries and their life expectancy might be shortened from their accident or injuries, the parents don't want to receive the payments as they were set up for their child who is now deceased. So in cases involving a minor, unless the minor injured child has siblings that they want the money to go to, the beneficiaries, as beneficiaries, we include a commutation rider on minors' cases. And again, any payments going to a beneficiary, whether it's in the commutation rider or if it's the stream of payments designed for the plaintiff, the beneficiaries also receive those funds on a tax-exempt basis. They also don't pay any tax on the structured settlement. So those are a lot of the advantages that come with the structured settlement that are not available in the marketplace. It's a very unique product for unique cases. So what types of cases qualify for a structured settlement? Mostly almost everybody. So if you have somebody who's temporarily or permanently disabled and they can't work, severely injured individuals who might have long-term medical or financial needs, minors, folks who are incompetent, whether due to the accident or prior to the accident, cases involving the death of a spouse. A lot of times we do a lot of work with construction workers, and when they pass, they leave behind, a young wife and children. So the structure would, go to the wife and children, and this way they can, have income coming in and college plans set up. So cases where there's a death involved of the spouse, where you have a wage loss, it could be full or partial. Sometimes the injuries are not that catastrophic and the individual can go back to working, but maybe at a lower wage rate. So the structure can help balance out what they were making before, kind of make them whole again. We also use structured settlements. I'm not sure if anyone's familiar with Medicare set-aside allocations, but those are allocations that are made in cases where a plaintiff is a Medicare beneficiary, and Medicare is paying their medical bills from the accident or incident. And Medicare requires them, when there's a third-party liability settlement, to set aside a certain amount for future use after a settlement. And what the purpose of that is Medicare has said, listen, we've paid your medical due to this accident all along, but now you're making a recovery on a third-party claim. And we think it's only fair that not only do you pay our lien that we might have from this accident and all the medical we paid, but we also want you to set aside a certain amount of money that after the settlement, you're going to use that first to pay for Medicare-related medical care or prescriptions. Once that's exhausted, then Medicare will step back in, and if that's the plaintiff's primary healthcare provider, then they will continue to pay their medical going forward. But when there's a third-party settlement, Medicare usually requires them to set aside money. Well, when you're doing that, instead of setting it aside in a lump sum payment, Medicare doesn't care how it's set up. They just want to make sure you're using a certain amount of money. So you can either set it up with a lump sum payment, or there's an advantage to doing it with a structured settlement, because payments are paid over time. You don't have to set aside as much as you would if you were doing it with a lump sum payment. So we use the structures to fund Medicare set-asides. And we do a lot of them in workers' compensation claims, because typically in workers' comp, Medicare, workers' comp benefits are going to stop, and then Medicare is going to then be the primary payer. And they don't want all of the burden shifted to them once workers' comp stops paying for medical treatment for the plaintiff. We also use structured settlements to fund special needs trusts. We probably do over a dozen cases a year involving a special needs trust. And where the structure is advantageous is, again, we fund the special needs trust with a lump sum payment. Obviously, you need to do that for seed money for immediate needs. Maybe they want to buy a house or a car, whatever Medicaid will allow. And then we have structured settlement payments flowing into the special needs trust tax-free for either the lifetime of the individual for the plaintiff, or again, for a set number of years. And that's tax-free money going into the trust. And a lot of trustees really appreciate the structure because it allows them to budget and make disbursements more easily than having to rely on just the investments that are incorporated into the special needs trust. They know that money's coming in and they can budget and plan and take, whatever, up to 4% annually using the structured settlement. So a lot of trustees really find the structure important in funding special needs trusts. Anyone lacking money management skills also. Like I said, most of the plaintiffs that we work with have no experience in finance, have no experience in the market. They live paycheck to paycheck. A lot of times when I talk to them about other investment products, something as simple as a money market or a CD, they're unfamiliar with the term. So someone who really doesn't understand the market can really, in some cases, be taken advantage of. And we want to try to avoid that. So we always try to recommend the structure. I know I talked a lot about the structured settlement being a fixed annuity, which it is. But we also have a lot of other products coming into the structured settlement arena that are advantageous and tax exempt. So for instance, Pacific Life Insurance Company offers not only the fixed annuity product, but it has a product which is an indexed annuity. And what that does is it follows the positive performance of the S&P 500. So when clients or attorneys say, oh, the interest rates are so low, I don't want to lock in for that long. Don't you have something that's a little bit more flexible? Yes. Again, those payments, though, because they go follow the lead of the S&P 500, they're unpredictable. However, with our product, because we are dealing with incapacitated people or injured people that do not have any income, we needed to have it a baseline at least. So with the Pacific Life indexed annuity, it follows the lead. There's a baseline amount. So let's say the payment starts out at $2,000 a month. If the S&P performs positively, then the interest rate would go up and then the payment would go up year to year. If the S&P does not perform or it has a very bad year, the structured settlement stays the same. So interest rates can only go up. It never goes down. And you always have that baseline. But there is a 5% cap. So it can never go up more than 5%. But again, that's for somebody who wants a little bit better interest rate and is willing possibly to take a little less money now on the indexed annuity monthly because the fixed rate typically starts out a little bit higher, but then it stays at that amount unless you're using a cost of living adjustment. So the Pacific Life is another product that is available. In addition to that, we also provide non-qualified structured settlements where there's no physical injury component. And those cases might be employment cases, sexual harassment, wrongful termination, discrimination, wrongful imprisonment. Those cases do not have a physical injury component for the most part, and therefore would be taxable, but tax deferred. So the structure, again, has all those bells and whistles of all the protections and the non-ownership and no 10% penalties, but the tax burden is spread among the years that they've received payments. So if you're doing, a monthly payment or an annual payment, they're only getting a 1099 in the year they received payments. So they can choose to take payments immediately, defer them, have a combination of both. But if they are taxable, but we do have a market for that as well. We also have a market, which a lot of attorneys find very interesting. And we use them a lot. It's an attorney fee structured settlement. So it's not tax exempt to the attorney, but it's tax deferred and income deferred. So if an attorney is settling a case in 2021 and he doesn't want to take all of his fee for a multitude of reasons, one, he doesn't want to show that much income for this year. Two, he might be getting divorced and doesn't want to show the income at all. Or he or she might want to plan for retirement. They can take, as part of the settlement, like a plaintiff would, part of their fee or all of their fee, and put it into a structured settlement. So if their fee is $1 million that they're getting from a settlement in 2021, they can take $500,000 upfront as their fee, and then place $500,000 into a non-qualified structured settlement. And again, they get to design the plan, when they want payments to start, how they want to receive payments, monthly, annually, semi-annual. Do they want to include lump sum payments, planning for, children's weddings? I've even done some attorney fee structures where we've planned for bar mitzvahs and bat mitzvahs. They know that at age 13, when their children are at 13, they're going to need some cash, and they do lump sum payments. And again, the advantage to the attorneys is not only, tax deferral, because again, they'll get a 1099 in the year's payments received, but they get to defer that income. And that's something that's not available in the market. Once they take their fee, that's their fee. It's planted in for 2021. This allows them to defer that income, again, for whatever reason they choose. But it has to be part of the settlement, just like the plaintiff's structured settlement. It has to be included in the releases, and it has to be funded by the party paying the claim, whether it's a defendant, liability carrier, self-insured. That party has to fund that structure on behalf of the attorney. And those payment terms are in the release as part of the settlement, where everyone has to agree to it upfront. So does anybody have any questions so far? I know I've just been kind of rambling on.
No, it's okay. Listen, you answered a couple of my questions about special needs trust. I was very interested in that, so I don't have to ask that.
Okay.
But you did mention something about the beneficiaries receiving the money tax-free. Is it estate tax-free as well?
No, it's not. Yeah.
It's not.
Yeah.
Okay.
So the structured settlement payments can bypass the estate, just like a life insurance policy, where the money would go, the monthly income would then just be paid directly to the beneficiaries, but the value of the structured settlement at the time of death would have to be included in the estate. So if the value is $300,000 at the time of death, that does have to be included in the estate, but then the payments themselves bypass that and go directly to beneficiaries.
I have a question. Kim, the attorney who's going to restructure his commission or his fees, how do they get around the assignment of income doctrine and the IRS's claim that he has constructive receipt?
Because he doesn't have constructive receipt. So the defendant that's paying the claim, instead of writing a check to the plaintiff's firm for $1 million for their whole fee, and then the attorney taking that money and investing it himself, the defendant sends him only $500,000 of his $1 million fee upfront. And then the defendant writes a check to MetLife or New York Life directly to fund the structure. And that's how we get around that constructive receipt issue. Payments are never paid to the attorney or his firm or any trust account. So he doesn't have actual receipt of that money. And there are case law that, if anyone's interested, I can send to them as well, and tax codes.
I think the biggest takeaway from this discussion for me is over the course of my career, I run into a person or an agent will ask me a question, and one of their clients was in an accident and they're ready to receive a claim and they don't know what to do or who to ask. And we now know Kimberly is a resource for that kind of information. And again, for those who weren't here at the very beginning, we had some attorneys that were in that position that had approached me about a month ago, and I knew then it was not my area of expertise, and I called Kimberly, and Kimberly got it solved, went back and forth with the judge, and now waiting for the contract to place. And the fact that she satisfied these attorneys, they're thrilled, and they now have a resource now, which is what this group is all about, is having a resource. When you have a question, your client has a question or a need, Kimberly is a vital resource in this area. And it is quite unique specialty, and and we're glad to have her as part of LIAFPN.
Oh, thank you. Thank you,
Have
Neil.
like a
Thank you.
write-up or something on these structured settlements, something that we could share, let's say with MedMal or personal injury attorneys?
Yeah, sure. Absolutely. I can certainly send out emails and I can bombard you with paperwork.
Well, not bombardment, but a
No, I
summary of
know,
it.
I know. Yeah.
Look, you know,
We try to keep it short and simple because a lot of people don't like to read too much information and we just kind of do bullet points. So yeah, I can certainly send out information that you can share with clients or whomever.
you know, that
Absolutely.
would be helpful. And something that you pointed out in your presentation, which is very important, is that a lot of times the recipient of an award is from a lower economic group that doesn't have the educational background to properly manage their money. It's like the lottery winners. All of a sudden, it's
Exactly.
$10 million and it's gone within 2 years.
Yeah.
The settlement will give them the opportunity to provide for their family and their lifetime. I mean,
Right. And, you know, a lot of times, you know, people say, well, I don't want my clients selling the annuity and JG Wentworth, you know, for 30 years, I've been watching plaintiffs, you know, like I said, when we structure a settlement, it's typically 50% or less than what they're going to net. And I've worked with individuals where we've done $1 million in a structured settlement and given them $1.5 million in cash. And in within 4 years, 3 years, 2 years, even months, that $1 million cash payment is gone.
Yep.
They buy homes for family members and don't hold the deeds. They invest in businesses that they have no business investing in. They know nothing about it. And they give away their money. You know, that sudden wealth syndrome is something that plaintiffs in my career I've seen. They just don't want to be in a different realm of an economic, you know, place. They want to be where they were with the people that they know best, and any amount of money is going to become a problem for them. So they tend to give it away or spend it foolishly, and they end up losing their money. And that's why a lot of times they'll go to JG Wentworth and want to sell their structure because they've dissolved the cash component, no matter how much it is. It could be millions of dollars, it could be $10,000, but it's just very poor money management on their part. And they think the money's going to be there forever and $1 million is never too much to spend. And then regrettably, it does dissipate very quickly.
So it sounds like an interesting option for the fixed income portion. And you could diversify it and have the equity portion that you invest in equities, which are not all, the income from that is not all that heavily taxed. And you can take the fixed income portion and put it in this. So the question then is, so you get the tax benefit of a huge deferral of the investment income on it, like an annuity, without the detriment of an annuity of the income being ordinary income, but you still have the cost of an annuity because the insurance company costs something to run the insurance company. So I guess I could figure what the tax benefit is, or I'd probably let one of the accountants figure what the tax benefit is. What is the flip side? What's the transaction cost?
Because we're agents or brokers for MetLife and Berkshire, we're appointed, you know, as you know, agents for them. We don't have their breakdown of what is encompassed in the cost of the structure. There's a commission that's paid. I can tell you that's a 4% commission that's paid to structured settlement consultants placing annuities. And aside from that, we've never been able to really obtain the nuts and bolts of what the MetLife costs are.
Are the structures typically payments over a fixed number of years, or are they typically over lifetime? If it's over a fixed number of years, it would be fairly easy to calculate the
right. It all depends on it all depends on the needs of the individual. When interest rates were a lot higher, we were doing a lot of lifetime annuities. Because of the interest rate environment, we have found if we did an annuity that paid to age 85 or 90, that you would get a better return than having the life component factor on there. So typically these days we're doing them for fixed periods of time. But again, we do have those cases where I just did one with a 22-year-old, unfortunately brain damaged young man, that the parents wanted a lifetime income because they want to know when they're gone from this earth that their child is going to receive that money, even if he lives to 110.
I guess there's some cost if you want lifetime rather than to age X, since there's some risk that that person is the one who lives to 110. But
Right.
if you had one that went to age X, what is the rate of return that you get? Because those are fixed payments. That's calculable.
Correct, right. So the interest rates that are generated, the tax exempt rate, I should say,
That's all right. It's
that
tax-free.
is, yeah, tax free, that's generated is anywhere from, 1.3 on something short term, 10 years, and upward to, 3% for 30, 35 years. And then higher, obviously, or on a young person or a minor for a lifetime.
So
So the
not,
interest rates work just like any other annuity. The shorter the term, the lower the interest rate, the longer the term, the higher the interest rate.
so a pittance compared to the expected return on your equities, but pretty reasonable compared to what you'd expect on the fixed income part of your.
Right. And
Well-
that's what we're saying. We're not saying that for these catastrophic cases that settle for lots of money, millions of dollars, we're not saying not to invest in the market. We're saying that there should be 3 pots of money: a cash payment, a structure for the fixed income portion to take care of your everyday living expenses. Like I said, food, mortgage, utility, rent, property tax. A lot of times people, they want to buy a house. The first thing I hear is, I want to buy a house, I want to buy a car. And they buy the house cash, and then they forget, oh, wait a minute, I still have property taxes, I still have utilities, I need income for that. So, right, for the fixed, that's what we basically strive to get people to do, is just put something away for the fixed portion, and then the other monies, invest in other things that are going to generate, a higher return. And then you don't have to touch, you can just leave it in there, let it ride and just, let it grow, and use the structure for fixed income.
Interesting.
Yeah, it is very interesting. I love what I do. Again, we get to work with attorneys and try to help injured individuals. I get calls years and years later from widows that, thank God I have the structured settlement because I don't know what I would do without it. And so it's very rewarding.
It's funny you say this. My father, who was a veterinarian, who was very big in the market for over 50 years while he's alive, one of the best things he used to tell me, he got a settlement for something, and he bought an immediate annuity through us. He says, this is the best investment I ever had, because every month I get a check. I don't have to think about it.
Right.
Every month it's in my account. I don't have to think about it. And you know what? That was from a guy who was very experienced in the market, loved the market. But every month he got a $300 check, didn't think about it. He said, that was the best investment ever. He goes, I
Right.
love this.
Right.
And-
Exactly. And I hear the same thing too. It's,
Absolutely.
it pops into your checking account and it's there. You don't have to think.
Yep.
And when we had the crash in 2008 and 9, we were getting phone calls left and right asking what was this going to do to their structure, and
Nothing.
just keep collecting your check, nothing. And
Yep.
nothing happened. So they were all very, very happy.
Well, we're running out of time. I did want to let
Okay.
everybody know, on July 15th, we will have a after hours kind of cocktail event. If anyone would like to join us at the Holiday Inn, you will be getting messages. You'll be getting an email follow-up. We'll also do a follow-up to this presentation as a thank you for attending. And we'll give you Kim's information if you'd like to reach out to her in that email. And very happy everybody's here to attend. We don't really have enough time to introduce everybody. I think everybody pretty much knows everybody. Anybody's a member of LIAFPN, one of the benefits is we do one-on-one introductions. We do it all the time. And we are a compilation of experts in every area of financial services, So if you have any questions whatsoever, if you run across a client who needs something, isn't it great to have these resources? And that's what we do on a day in, day out basis. So I want to thank you all for coming. If there's any other questions, please ask away. And I want to be respectful of everyone's time. And
Neil, did you say Holiday Inn for the 15th or
Yes.
the Hilton?
Oh, the Hilton, I apologize.
On
Hilton.
Spagnoli and Oak and 110.
The Hilton, I apologize.
Close enough.
I was thinking of the song in the back of my head, you know, hotel, motel, all.
Yeah. Oh,
Ready for a drink.
oh,
I'm ready for multiple.
well, I really want to
Yes.
thank everyone for joining me, and it was
Thank
nice
you.
meeting everyone. And if you have questions, please feel free to reach out. And if I can help anybody in any way, please give me a call. And I'll be glad to pass your names around too for those who might be in need of your services as well.
Excellent. Okay, thanks
Okay.
again.
Thank
Have
you.
a great day, everybody.
Have a
You
good
too.
day.
Bye. Thank
Take
you.
care.
Have a great
Take
week.
care,
Bye-bye.
everyone. Bye-bye.